You need to hear this because something important is happening right now in silver, and most people are reacting emotionally instead of understanding the mechanics. In less than a week, silver collapsed from $121.64 to an intraday low near $71. That's over 30% gone, fast. And even this Monday open, with silver hovering around $81 to $82 an ounce, the pressure hasn't disappeared. The real trigger isn't fear, and it's not some sudden change in fundamentals. It's mechanical, it's forced, and both the futures exchange and the banks just confirmed the conditions that caused it. Stay with me, because if you understand this, you'll recognize it the next time it happens, before the crowd does. Before I explain what caused this move, let me teach you something most traders never really internalize. Markets don't just move on opinions, they move on plumbing, on leverage, on rules. Think of leverage like driving fast on a narrow road. It works beautifully until the speed limit suddenly drops, and then everyone has to slam the brakes at the same time. When exchanges change margin requirements, they're changing the speed limit instantly. You don't get a vote. You don't get a warning window. You either post more cash or you sell. And if you're highly leveraged, you sell now. That's what you need to understand before you look at any silver chart today. See, margin requirements are basically a deposit. When you trade futures, you're not putting up the full value of the contract. You're putting up a fraction, maybe 10 or 15%. That lets you control a lot of silver with a little money. Great on the way up, brutal on the way down. Because here's what happens. If the exchange decides overnight that the deposit just went from $10,000 to $13,600 per contract, you've got to find that extra cash immediately. Not tomorrow, not when it's convenient, right now. And if you can't find it, the broker liquidates your position automatically. They don't ask, they don't negotiate, they sell. Now multiply that across thousands of traders globally, and you start to see how this becomes a cascade. The selling itself pushes the price lower, which creates more margin stress for the next group of traders, which forces more selling, which pushes the price even lower. It's a feedback loop, and it doesn't care whether silver is fundamentally cheap or expensive. The machine just executes. So, when I talk about mechanical selling versus emotional selling, this is what I mean. Emotional selling is someone reading a headline and deciding silver's going to zero. Mechanical selling is someone getting a margin call at 3 in the morning and having no choice but to liquidate because the math demands it. One is optional, the other is mandatory, and right now, what we're seeing is mandatory. Now here's what's actually happening. As global markets reopened, the CME group raised silver margin requirements by roughly 36%. That means anyone holding leveraged futures positions suddenly needed a lot more capital just to keep the same exposure. So what happens? First, weaker hands can't meet the margin call. They liquidate. That selling pushes price down. Second, falling prices trigger even more margin stress, forcing the next layer of traders to sell. And third, the cascade feeds on itself. But here's the part that should make you pay attention. This isn't opinion-driven selling. It's automatic selling. There's no discretion involved. The broker's risk management system sees the account value, sees the margin requirement, does the math, and sells. Period. What's wild about this is that it happens regardless of whether silver is cheap or expensive fundamentally. The machine doesn't care about your thesis. It doesn't care about supply deficits or industrial demand or monetary policy. It just sells, and that's why you see these moves that look completely disconnected from the news cycle. People scramble to find a headline that explains it. They look for a catalyst. They search for some geopolitical event. But the real catalyst was buried in an exchange notice that most retail traders never even saw. A margin hike, a rule change, boring, technical, invisible, until it's not. Now, let me show you what most people are missing. The timing. These margin hikes didn't happen in a vacuum. They landed as liquidity was thinner and as reports circulated about positioning tied to JPMorgan Chase. Add in temporary disruptions and delays at the London Metal Exchange and HSBC, and the effect hit leverage retail traders hardest. Is that proof of intent? No. But is it proof of asymmetry? Absolutely. Strong hands can sit through this. They've got the capital. They've got the time horizon. They're not using maximum leverage. Weak hands can't. They're stretched. They're using borrowed money to amplify returns. And when the rules change mid-game, they're the ones who get flushed out first. And that's why you're seeing price whip around violently even after a bounce. Think about what happened in the first 48 hours after the initial drop. Silver bounced hard off that $71 low, shot back up toward the mid-80s. People started calling the bottom, started saying the worst was over. And then, what happened? It rolled back over. Why? Because the forced selling wasn't done. The margin requirements were still elevated. The stress was still in the system. And every rally became another opportunity for trapped longs to get out at a better price. That's the nature of these mechanical moves. The first bounce feels convincing. It looks like capitulation happened. It looks like sellers are exhausted. But it's a head fake, because the real exhaustion doesn't happen until the leverage is completely wrung out of the system, until every trader who was overextended has either posted more capital or been liquidated. Only then does the selling pressure truly fade. If this is making sense, drop a comment below and let me know where you're watching from. I want to know if you're seeing this play out in real time or if you're learning about it after the fact. This is the exact same playbook we've seen before. Go back to 2011. Silver crashed hard off its peak near $50. It bounced early. People thought the correction was over, and then it retested lower as forced selling finished its job. It chopped around for months before finding a real base. Same mechanics. Different decade. Look at March 2020. Different asset, same mechanics. When COVID hit and liquidity froze, we saw this across the board. Gold, treasuries, even Bitcoin got hammered. Why? Because margin calls don't discriminate. When funds need to raise cash, they sell what they can, not what they want. And the assets that had run the hardest, the ones with the most leverage behind them, those were the ones that got hit the worst. In that March 2020 example, gold dropped from around $1,700 to below $1,500 in a matter of days. Everyone was confused. Isn't gold supposed to be a safe haven? Isn't it supposed to rally during a crisis? Sure, eventually. But first, the leverage has to clear. First, the forced selling has to run its course. And what happened next? Gold found a bottom, consolidated, and then went on to make new all-time highs within months. Every time this happens, the first bounce feels convincing. And almost every time, it isn't the bottom. That's the lesson. The initial snapback is usually a reflex. It's short covering. It's bargain hunters stepping in. But if the underlying stress hasn't resolved, if margin requirements are still elevated, if liquidity is still impaired, then the move isn't over. When you zoom out, the larger story isn't manipulation or panic. It's structure. It's leverage being wrung out of the system before a real base can form. And here's the thing. This process is actually healthy in the long run. It's painful if you're caught in it, but it clears out the weak hands. It resets positioning. It creates a foundation for the next leg higher, if and when that comes. Think about what leverage does to a market on the way up. It amplifies demand. It pushes prices higher, faster than fundamentals alone would justify. And that creates fragility, because the higher it goes on leverage, the more violent the unwind when the leverage reverses. So, in a weird way, these crashes are the market's way of resetting itself, of saying, okay, we got ahead of ourselves, let's clear the deck and start fresh. Now, let me be skeptical for a moment, because you should be too. Could this be overblown? Could silver rip higher tomorrow and make all of this irrelevant? Of course it could. Markets love humbling, confident narratives. I've seen it happen. I've been wrong before. And claims that everything is engineered can become a trap if you stop analyzing data and start seeing ghosts everywhere. The thing about manipulation stories is they distract you from what you can actually observe: price, volume, volatility. Whether you think JPMorgan is orchestrating this, or whether you think it's purely mechanical, your job as a trader or an investor is the same. Watch the data. Watch the behavior. Watch what the market is actually doing, not what you think it should be doing. Could there be coordination between exchanges and large institutions? Maybe. Could these margin hikes be timed to maximize disruption for retail traders? Maybe. But here's the thing. It doesn't actually matter whether there's intent or not. The mechanics are what matter. Focus on what you can control. Focus on confirmation, not outrage. If you spend all your time angry about manipulation, you miss the actual trade setups. You miss the levels that matter. You miss the signals that tell you when the forced selling is done and when real accumulation is starting. Outrage is expensive. It clouds judgment. And in markets, clouded judgment costs you money. So, Yes, be skeptical of narratives, including mine. Don't just accept what I'm saying because it sounds smart or because it fits your bias. Go look at the CME data yourself. Go check the margin requirement history. Go look at volume patterns and volatility signatures. Do the work, because that's how you develop conviction that isn't based on someone else's story. There are probably three types of people watching this right now. The first is already long silver and feeling that knot in your stomach. Maybe you bought physical, maybe you bought minors, maybe you're holding futures, and you're watching your account value swing wildly, and you're wondering if you should cut losses or if you should hold on. If that's you, your job isn't to predict the bottom, it's to survive. And survival means managing risk, not trying to be a hero. Watch volatility. Watch whether selling pressure fades into the US close. Watch whether silver can hold key levels or whether it's still making lower lows. If you're overextended, if you're losing sleep, if this position is threatening your financial stability, then you need to get smaller. Period. There's no shame in that. The market will always give you another opportunity, but only if you're still in the game. On the other hand, if you're holding physical silver and you're not leveraged, then this is just noise. Your job is to zoom out. Ask yourself, did the fundamental thesis change? Did industrial demand disappear? Did central banks suddenly become fiscally responsible? If the answer is no, then short-term volatility is just part of the game. Ride it out. Maybe even look at it as an opportunity to add if you've got dry powder and conviction. The second type of person watching this is the one who missed the run-up and is eyeing this drop like a gift. You're thinking, okay, silver went from $30 to $120, I missed it, but now it's back in the 80s. Maybe this is my chance. And you're not wrong to be interested. But patience is your edge here. Early bounces are seductive. They make you feel like you're getting a deal. But confirmation pays better. What does confirmation look like? It looks like volatility compressing. It looks like higher lows forming. It looks like volume drying up on the sell side and starting to pick up on the buy side. It looks like the market proving to you that the forced selling is over, not just pausing. If you jump in too early, you're catching a falling knife. You're buying into ongoing liquidation. And yeah, you might get lucky and nail the bottom, but more often you're just adding to a position that's going to test your conviction hard before it works. So if you're in this camp, my advice is wait for stability. Wait for the market to show its hand. Let the weak hands finish selling. Then step in with size when the risk-reward actually favors you. The third type is just trying to learn. You don't have a position. You're not trading silver, but you're watching this because you want to understand how markets actually work. And here's the lesson for you. When margin rules change, price behavior changes first. Explanations come later. That principle applies to every market you'll ever trade. You'll see it in crypto. You'll see it in commodities. You'll see it in equity indices. Whenever an exchange or a clearinghouse decides to adjust risk parameters, there's a structural impact that shows up in price action before most people even know the rule changed. And if you can recognize that signature, if you can identify forced selling versus discretionary selling, you'll have an edge that most retail traders never develop. So here's what I want you to answer in the comments. Which of these three groups are you in? Are you holding and feeling the pain? Are you waiting for an entry? Or are you just here to learn? Let me know, because I'm curious where people are positioned mentally right now. Now here's where I stand. I'm not panicking and I'm not chasing. I'm watching. Let me tell you what I'm personally watching. First, I'm watching that $80 to $82 zone, because holding or losing it tells you whether forced selling is still active. If silver can stabilize here and start building higher lows, that suggests the worst of the liquidation is behind us. If it breaks down through 80 and heads toward the mid-70s, that tells you there's still more stress to work through. Second, I'm watching the $70 to $75 area as a potential deeper washout if stress isn't done. That would represent roughly a 60% retracement from the peak, which historically is where a lot of these leveraged unwinds find exhaustion. It's not a prediction, it's a watch level, a zone where I'd expect to see real buyers step in if we get there. Third, I'm monitoring volatility itself. When volatility stops expanding, the machine is powering down. Right now, you're seeing huge daily ranges, 20% swings. That's the signature of forced liquidation. But when those ranges start compressing, when you see a few days in a row where silver trades in a tighter band, that's your signal that the selling pressure is fading. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The fundamental picture for silver hasn't changed overnight. You've still got supply deficits. You've still got industrial demand from solar, from electronics, from green energy infrastructure. You've still got central banks running deficits and printing money. None of that disappeared because the CME raised margin requirements. What changed was the leverage structure. What changed was the positioning of speculators who were using borrowed money to amplify their bets. And when that leverage unwinds, it creates violent price moves that have nothing to do with the underlying asset's value. It's purely mechanical. If history rhymes and silver consolidates here, builds a base, and starts moving higher again, the move that follows could be significant. Because all that forced selling, it creates a void. It clears out the weak hands. And when demand returns, when real buyers step back in, there's less supply to absorb them. That's when you get the explosive moves. That's when you get the runs that catch everyone by surprise. But we're not there yet. Right now, we're still in the cleanup phase. We're still watching to see if the system has flushed out the excess leverage or if there's another wave coming. And that's okay. You don't have to call the exact bottom. You just have to recognize the process and position accordingly. I'm not a financial advisor. This is not financial advice. I'm not telling you to buy silver. I'm not telling you to sell silver. I'm showing you how to interpret what's happening so you can make your own informed decisions. Do your own research. Talk to a professional if you need to. But don't outsource your thinking to someone else, including me. If you made it this far, you're the type of person who wants to understand the game, not just play it blindly. That mentality will serve you well, because markets reward people who think critically, who verify data, who stay calm when everyone else is panicking or euphoric. That's the edge. Not some secret indicator, not some inside information, just disciplined thinking applied consistently. So, if you found this useful, share it with someone who's trying to make sense of what's happening in silver right now. Hit the subscribe button if you want more breakdowns like this when major market events unfold. And drop a comment letting me know what you're watching or what questions you've got. I read them, I respond, and I use your feedback to shape what I cover next. Stay sharp out there, think critically, verify data, and make your own decisions. I'll see you in the next one.